Hi, everyone. My name is Brendan McCarty. I am CIO and founder of Column E, and I welcome you back to another 5 charts of interest. This week, we'll be covering various charts across our little purview, if you will, and looking at the banks, covering some liquidity, reviewing a chart that we posted on a rundown a couple weeks ago, and ending with a very interesting chart of equity exposure. Before we proceed, if you'd like to learn more about Column E, you can visit our website at columne.com, or you can email me, brendan@columne.com. We'll give you some more information. Like I said, we'll chat whatever you want us to do. So thanks again for joining us. Without much ado, let's proceed with this week's 5 charts. Leading off, as part of today's discussion, on intriguing trends across various markets, our first chart zooms in on a sector that often serves as a bellwether for the broader economy, the banking sector. As you can see from the July onward, the banks have been very weak. The weakness tied to the latest hike by the Fed that created overall tight policy. In short, this is the market voting on the latest move by the Fed, or more specifically, the banks voting. Once again, that the latest hike was bad for the banking system in a similar fashion to the spring. Will we have another Silicon Valley Bank crash or First Republic? Debatable. However, the banking system is fragile right now and getting worse. Tied along with the interest rate hike from the end of summer, liquidity is also tightening with the latest report, though, as we show, still in a range. But right now, markets are tight. Fed policy is tight, and the banks do not like it. Conditions are worsening. Moving on to our second chart is the home builders and the Bitcoin trends. We've shown this chart many times. Essentially, crypto markets have been following the home builders. Basically, risk and technology could run crypto up against various markets, but they've been following each other for a while. This chart's been particularly close for the last since 2016. As you can see, Bitcoin ran ahead of the home builders, fell down with the home builders, and hasn't resumed its rise with the home builders. Couple different takeaways from this. First, BTC is probably suffering from the US dollar getting stronger. Dollar has busted out to the upside, supported by our fundamental models on it. Conversely, crypto's fundamental model for the crypto markets has actually weakened. Home builders, though, with their latest trip lower, might actually be weakening, getting closer to the joining Bitcoin lower. They've been giving away a lot of incentives lately to counter these high interest rates. And essentially, the real estate market these days for sales is tied up in these new homes because there's not a lot of residential supply, though I guess of late things have changed there. Question is, will the home builders follow Bitcoin lower? Or will BTC close the gap and bounce? That's why I'm watching 25,500. That level has held several times, but the fundamentals argue it will break. So until then, home builders might be the one that migrates lower versus versus Bitcoin falling further. If Bitcoin gives up on 25.5, that could argue a steeper fall for home building, because it probably argues that people are using crypto and Bitcoin as a source of cash. Perhaps that is part of the reason this fell so hard in the last couple weeks. But the fundamentals are weakening as well for crypto and perhaps residential real estate, as the demand and the supply are out of whack. This is our third chart. This is our 25 times GAAP PE. We don't typically look at it, but I found it on the stock charts years ago, and I looked at it. It's got a lot more data than the old trailing data that I have. Whenever we cross 25 times earnings, market has to make a decision. It can go to 35 times earnings, which is the next level on the chart, or it can reject 25 times and fall. So if it goes to 35 times earnings, we're looking at an S&P of 6,100. I'm not sure if there's enough risk in the market or liquidity to propel it like that, since we're not seeing similar trends like we did in 2020-21, where liquidity was shooting higher, as was risk. Conversely, if it rejects 25 times and falls to 22 times, or even worse, 19 times, you're looking at an S&P of 3420, which was near the previous lows from the fall, or 2992, which we haven't seen in quite some time. 3420 would actually tie better, arguing that the last 7, 9, 12 months was a mirage of a rally, because liquidity hasn't really bounced too much. It surged higher in the spring, but it's leveled off. It's still higher than the October lows of last year, but it's trailing lower now. So typically, the only way to offset this is risk, and risk is doing its job by markets going higher. But as we've said many times, the risk is a fickle animal. So we're watching the 25 times earnings level. It breaks through at 25 times. We don't typically think in long-term themes, but this is a long-term theme to worry about for if you're an equity investor. It argues for PE compression in real earnings. That's what GAAP earnings really are versus operating. GAAP earnings start to fall. Eventually, this will lead through into operating earnings. All right, liquidity, as I mentioned, you can see it's in a range. It's been in a range since October of last year. That's when the Fed basically slowed down the decline in liquidity. The Bank of Japan was also doing their thing, flooding systems with money. Recent updates show liquidity is trending downwards through the 20-week average, though not much. One would suggest this equals a flat performance for the S&P, but that is not the case, as the S&P is up almost 17% this year, if I'm not mistaken. Let's add another variable to this equation, though, and it's risk, as I mentioned. As measured by our ERT model, risk is climbing at its most aggressive rate since the pivotal shift we witnessed in 2020. This is coupled with rising earnings growth, though trailing earnings are level. This gets interesting at a couple levels. First, the PE breaks through, PE starts to decline. That's going to put downward pressure on risk. If earnings on the trailing basis start to decline, risk is going to face further pressure. And if this model rolls over with falling trailing earnings, the S&P could be in real trouble given where liquidity is. So we're watching this chart. We'll see where it goes. In a market that's driven by liquidity, actually driven by risk right now and not supported by liquidity, there's less real support for it to go higher and more easily fall lower. All right, last one is this massive drop in exposure. So I just shared you 4 negatives essentially, and now I'm going to share you a positive, or it depends. The NAAIM index, which is the money managers index that we read about from time to time, has fallen dramatically over the last 5 weeks. In fact, the fall over the last 5 weeks is the biggest one since May of 2020, when the Fed last started hiking rates, actually. Leading into that, the markets were trembling a little bit. I believe we topped somewhere in April. Didn't like the fact that the Fed was going 50 or 75. I can't remember at this point. But that hike was coupled with a massive drop in this NAAIM index. The markets would eventually not recover from this drop until August, September. It did bounce in July, surged in August, fell into the end of September, and then we stabilized, as the previous chart showed. Before the Fed was hiking rates and before liquidity was an issue, these little drops were buying opportunities. So it depends where we are. If we're in a market that has no support of liquidity, and that's debatable because it is going sideways, and there is risk, this very well could serve as a buying opportunity for the next run higher into the fall. That could explain why we've also seen surges in buying in the futures all month. The money managers have been selling. That means as they winded down their exposure, it's at 30-something% now. That means there's not a lot of people left to sell. Granted, people could just sell more, I suppose. You could take it down to 15% like it has, as we show in those boxes. If the selling doesn't pick up, that's why the buying has been so influential in moving the S&P futures by not a couple points, but by like 15 or 20 every time a surge comes in. On Powell's message today, the volume of 3,000 and 4,000 contracts was moving this market big time. On the downside, the selling, there'd be a big 7,000 contract move over a couple minutes, and then it would quiet out. So let's put it this way. A long story short, NAAIM has seen a lot of selling in the last 4 weeks, and this is typically argues that the selling could be drying up. Again, it could go lower, just as it did in 2022, as it serves as a momentum indicator. So next couple weeks will be quite interesting as it relates to this indicator. All right, thank you everyone for joining me for another Call Me video and the latest 5 charts of interest. Hopefully, excuse me. Hopefully they were interest to you. You can follow me on Twitter, LinkedIn, and catch our latest notes at callme.com. We post 3 to 4 times a week on our blog between the columns, and we recently refreshed our website to share more on our company, more on the investing options, Harbinger LR Fund, and the 3LW strategy, which features our 3L100 strategy, released every Monday on yourfinance.tv. and other media forms. Anyway, thanks again for joining us and have a great weekend.